All right. Yeah, we're live. Hey, thanks for joining me today. I am going to talk about PayPal and Disney. So, this is a little off the beaten path for this channel. I usually don't look at specific stock names, but I got this idea from Spot Gamma's video, some OPEX stock rally, post OPEX stock rally candidates. And I put the link to their YouTube video in the comment section. So I recommend you go check out that video if you're interested. They're basically looking at a very specific market internal, which is the volume of put options in individual names that rolled off last Friday. Okay, on the 17th, there was this huge derivatives roll off. Basically, a lot of put options expired. Okay, and the idea there is that dealers will have to unwind their short futures positions because they're no longer short those names to offset the puts they sold. Dealers tend to be flat. They don't take a direction. So if they're selling a lot of puts, that means they're net long. They have to sell futures, or they have to sell the underlying in order to remain flat overall. When those puts roll off, when they expire, they're now left with this short futures position that they have to buy back, right? So there's this passive, meaning it's not driven by any sort of fundamental news or technical news or anything. It's just a passive purchase that the dealers are going to have to make. It's the same basic idea for one of the hypotheses out there for the Santa Rally this year, that the Santa Rally will be on steroids. I'm going to stop sharing for now since I'm just talking. And that hypothesis states that passive dealer flows will add to other forms of passive year-end positive equity flows and basically will overwhelm in a liquid market with like a moonshot Santa Rally. Now, I personally remain dubious of this argument for reasons I've talked about in other videos, but at the same time, I'm willing to take a look at how would I best play this, and I do like the idea of targeting these stocks with a large structural dealer bid post OPEX options expiration. All right, so let's get into specifics. The two stocks that I picked from their list were PayPal and Disney. Okay, I didn't like some of the other names as much because, like for example, Delta, I don't like the chart pattern as much for one. For another, it seems very kind of related or maybe even reliant on Omicron travel, right? Let's just say coronavirus in general, COVID news in general. I don't really want to put myself at exposure to, one bad headline killing the trade. Same story with like something like AMC. I don't understand that what the drivers are. It's a very traded stock. It's like a kind of a specialty stock, right? In these, what are they called, Reddit threads. So I don't want to mess around with that just because I feel like there's always randomness, but it just seems like there's more kind of capriciousness in those names. And I didn't like the appearance of the stock charts as much. Okay, so coming back to the ones I did pick, we've got PayPal, and we've got Walt Disney. Okay, so let's look at specifics. So let's see. So I'm going to walk you through how I structure a trade like this and plan it out. To be clear, I'm not recommending this trade. This isn't investment advice, and at this point, I'm not even saying I'm going to paper trade this. But with that out of the way, out of the list that Spot Gamma recommended, again, I like PayPal and Disney. To start with, this is the daily percent of daily volume that the dealers are going to have to buy back. So the Delta hedge that expired on OPEX for PayPal was 51% of their daily traded volume. For Disney, it's 67%. So those are very large numbers if we're talking about like a passive flow of buying. Okay, the next thing is I like the chart patterns. So in spite of them both being in bear markets, they both had this sort of bottom, or what you might think could be a temporary bottom. And then they have buy tails. In Disney's case, both Wednesday and Friday. In PayPal's case, just Friday. But they also had these buy tails back here kind of down around the same level, like it's a little lower, but below 184. So I like both of those chart patterns. And then the other thing that I look at is like a blue sky target. What is the blue sky target multiplier? And in this case, I'm targeting the 50-day moving average. Now what does that mean? Blue sky target multiplier. That means like if everything worked out and the chart went bananas, perfect, and we rallied, what's the most it could rally that I could feasibly see it rally? For Disney, it's 160 by Thursday. PayPal, it's 210 by Thursday. Okay, so those are the two prices I picked. Again, I'm not saying that I expect prices to rally to there. I'm saying that there's a 1 in 10 chance, or maybe 1 in 100 chance that it would rally to that point. And if it did, what's the multiplier on the capital committed to the trade? So in their cases, those were the two of the highest ones. So anywhere from 7 to 25 in PayPal, 5 to 12 in Disney. Now, in terms of which strike am I going to pick, I'm going to pick the one where the convexity maxes out. So the multiplier is still higher. You have to go to a higher strike before the multiplier starts coming down. Like you see the multiplier in Disney comes down between 155 and 157.5. But again, this is a blue sky multiplier. Everything has to go right for that to pan out, right? It's a very low likelihood chance. So what I'm looking for is where the convexity maxes out. So when does the difference between strike prices max out? For PayPal, it was at 192.5. For Disney, it's at 150. So the convexity here, since these, if you're like auditing this, there's a 2.5 cent or dollar strike difference between those two and only a 1. That's why I'm multiplying by 2.5 in there. And I'm going to round down. So the convexity is the same between those two strikes. I could have picked 152.5. I'm always going to pick the lower strike in that case. Okay. So these are roughly 20 or 30 delta calls. For PayPal. It's a smaller. For Disney, it's a larger. And blue sky multiplier is 6 and 13. So they both have large blue sky multipliers. They both have a daily buy tail. They both have a very significant amount of delta hedge that's going to have to get unwound. In terms of implied vol versus realized vol, so if you're just looking at the 30-day vol, you might think, wow, these options are cheap. PayPal is trading 7 vols under, Disney's 2.5 under. But if you look at the charts a little more carefully, you realize that, well, for PayPal, there was like this disastrous earnings call for them about a month ago. And for Disney, they got hit really hard when Omicron came out on November 26th. So there's kind of like this big difference between the realized 30 and the realized 10. So I did a realized 10 as well. In that case, they're kind of expensive. They're 3 vols too expensive, but that's not unusual. So you're always going to pay a little premium when you're buying options because dealers sell more than they buy and they set the prices. Okay, so this is not out of line. I wouldn't say that they're super cheap options, but it's not out of line. You could look at this as an argument against doing the trade. I think it's a fair price. I list my call strike preference. So this is more into now the planning aspect of this trade, the cost, the number. Now these are stale quotes, so this cost would change. An estimated total capital. A net zero exit. So where would I exit on the chart pattern? If I'm like zero, this is net zero exit means like if I exit a third of the position, I'll have paid for the whole position, right? So these are believable points on the chart patterns. I checked that out. And then if everything worked out and I sold the other 2/3 at the blue sky target, what would I make and what's the ROI? Those are both compelling ROIs. So again, I'm not saying that I'm going to make this trade, but I like this trade setup. In this case, these two names are pretty compelling. 2 big reasons I don't like this trade. These stocks are both in a bear market, right? And so you're kind of like in a hunting for a bottom, and I'm not a big fan of that. And then the other reason is I'm actually bearish the stock market, right? So I'm looking at this as, okay, well, this could be a hedge against my more sort of fundamental thesis that the stock market's going to close the year down around 4,400. Sure, but it could be a Texas hedge where the S&P does fine, let's say stays where it is or even rallies, and these stocks drop because they're in a bear market, right? So you lose on both sides. That could happen. It could also happen, though, I'll put it out there, that these rally and the stock market falls. So both could work. The most likely thing is that one of them works and one of them doesn't. That's like probably a 70% chance that one of these ideas would work and one of them won't. So it could prove a very useful hedge to the bearish stock market hypothesis I have. You always have to remember, though, that you can lose in both directions. It's not a pure hedge. Keep that in mind. Okay, that's all I have for you. Thanks for watching. Cheers.